Hey Hind everyone, welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge, etc. Today I will discuss some potential overseas posting examination questions and their corresponding sample answers for bankers. Today marks 6 of my path to the corner of a series for overseas posting examination questions and their corresponding sample answers for bankers. Now MCQs from pre-shipment and post-shipment finance. Each status holder category requires minimum export performance of rupees 2000 crore. Option A 4-star export house, B 5-star export house and premier trading house, C 3-star export house, D star trading house. Answer is option B 5-star export house and premier trading house. Next question is packing credit for deemed exports is liquidated differently from regular exports because option A deemed exports involve foreign currency receipt which is credited against packing credit. B. No foreign exchange received occurs. Incentives come in rupees. Proof of supply liquidates the credit. C. EXIM Bank directly settles the packing credit for deemed exports. D. The ECGC policy covers deemed export packing credit automatically. The answer is B. No foreign exchange receipt occurs. Incentives come in rupees. Proof of supply liquidates the credit. The next question is under FEMA regulations, export proceeds from a standard export must be realized and repatriated within how many months from the date of shipment? A. 6 months, B. 9 months, C. 12 months, D. 15 months. The answer is option B. 9 months. The next question is for exports to warehouses abroad as permitted by RBI, the time limit for realization of export proceeds is option A 9 months, B 12 months, C 15 months, D 18 months. Answer is option C 15 months. The next question is EDPMS used by RBI to monitor export bills and their realization stands for option A Export Data Processing and Monitoring System, B Export Declaration and Payment Management System, C External Debt and Payment Monitoring System, D Export Documentation and Processing Management System. The answer is option A Export Data Processing and Monitoring System. Next question is an authorized dealer AD bank in India is a bank authorized under which legislation to deal in foreign exchange? Option A RBI Act 1934, B Companies Act 2013, C FEMA Foreign Exchange Management Act 1999, D EXIM Bank Act 1981. Answer is option C FEMA Foreign Exchange Management Act 1999. Next question is the body that sets rule and guidelines for foreign exchange transactions by banks in India other than RBI is option A ECGC, option B FIEO, option C FEDAI, option D DGFT. Answer is option C FEDAI. The next question is NTP normal transit period in export credit refers to option A the time taken for goods to reach the destination port, option B standard transit time fixed by FEDAI for a currency or country pair during which interest is not charged on post shipment credit while waiting for payment after document presentation. Option C the time allowed by RBI for converting foreign currency proceeds to rupees. Option D the period between packing credit disbursement and shipment date. Answer is option B, standard transit time fixed by FVDAI for currency and currency pair during which interest is not charged on post-shipment credit while waiting for payment after document presentation. The next question is RCMC registration cum membership certificate is issued by option A DGFT, option B Ministry of Commerce, option C Export Promotion Council, EPCs and FIEO, option D ECGC. The answer is option C Export Promotion Council, EPCs and FIEO. The next question is duty drawback DBK is essentially option A a penalty imposed on exporters who delay shipment, option B a refund of customs and central excise duties paid on inputs used in the production of exported goods, option C a government subsidy given at the time of packing credit sanction, option D an advance given against future duty payments. The answer is option B a refund of customs and central excise duties paid on inputs used in the production of exported goods. The next question is RODTEP, the current primary export incentive scheme, stands for option A refund of overseas duties and trade export proceeds, option B remission of duties and taxes on exported products, option C reimbursement of domestic taxes on export products, option D remittance of duties for trade export promotion. The answer is option B remission of duties and taxes on exported products. The next question is RODTEP replaced which earlier scheme as a flagship export incentive? Option A duty drawback scheme, option B DFIA duty free import authorization, option C MEIS merchandise exports from India scheme, option D EPCG scheme. The answer is option C MEIS merchandise export from India scheme. The next question is banks can provide advance to exporters against their future entitlement to duty drawback. This advance is repaid when option A the exporter ships the next consignment, option B actual duty drawback refund is received from the exporter, option C ECGC settles the claim, option D the banking credit is disbursed for the next order. The answer is option B actual duty drawback refund is received by the exporter. The next question is the key difference between buyer's credit and supplier's credit is option A buyer's credit is for importers, supplier's credit means the exporter extends long-term credit to the importer. Option B supplier's credit is cheaper than buyer's credit. Option C buyer's credit is only available for project exports, supplier's credit is for all exports. Option D supplier's credit is given by EXIM bank directly, buyer's credit by commercial banks only. The answer is option A. Buyer's credit is for importers. Supplier's credit means the exporter extends long-term credit to the importer. The next question is, in supplier's credit, the exporter's bank finances the exporter by option A. Paying the exporter from Exim Bank's LOC. Option B. Discounting the deferred bills drawn by exporter on the importer. Option C. Opening a letter of credit in exporter's favor. Option D. Providing a standby LC to the importer's bank. The answer is option B, discounting the deferred bills drawn by the exporter on the importer. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.